Good evening and welcome to another episode of IJS Speaks. This is your neighborhood financial economist, Katie Mark. And today is November 19th. It's fairly late Eastern Standard Time, just after midnight. Asian markets are underway. And I just wanted to take a second to give an update on what I'm looking at on my trading dashboard. So, and also on the trade book coming into the back half of the trading week. So we'll start with the dashboard. First couple trading sessions, I was looking at the correlation between the dollar as my predominant safe haven asset and the other assets on my dashboard. Now what I noticed was the correlation between the dollar and the 10-year treasury went negative. So effectively the 10-year treasury started trading like a risk asset, and at the same time the correlation to gold went positive with the dollar. So basically meant that gold was trading like a safe haven asset. So that was the one adjustment I had to make to the analysis. I had to swap out gold for the 10-year as my other safe haven asset. So coming into the end of the Wednesday session, New York finally got to see a little bit of movement, especially in equities. The S&P finally moved. Gold has been slowly drifting lower. The dollar looks like it's putting in a bit of a bottom. I'm currently looking for a support and resistance level to hold, where old resistance turns to new support to confirm the reversal on the dollar. But I have other things that I look at that kind of hinted towards that. So I've actually started repositioning parts of the trade book to reflect a reversal in the trend of the dollar. So with the dollar reversing higher and the 10-year treasury now back positively correlated to the dollar, which is already trending higher, it looks like with both of my safe haven assets appreciating and trending higher, that the dashboard is hinting towards a risk-off sentiment. And with my risk assets being gold, stocks, or the S&P, and crude or commodities, in risk-off sentiment, I expect those to sell off. So gold has already started selling off. The S&P has also started selling off. Crude oil still fighting the urge to sell off. And but in along the lines of commodities, I was able to close out the front contract on my calendar spread for corn. So I was looking at the price over the past couple days, past couple trading sessions, and I got confirmation on what I believe to be a reversal point. So I was able to close out the first leg profitably. Now I am looking at correlated with the reversal in the dollar. With the reversal in the dollar higher, I expect to put downward pressure on commodity prices. So the front leg of the trade was long. The dollar has been falling in the past few trading sessions, which is putting upward pressure on commodities. I'm looking at the dollar reversing. Took profits on the long commodity side of the trade, and now with the dollar appreciating, I'm expecting the short side of the trade to start benefiting from that. So that's the update on corn. Also, with the spot forex part of the portfolio of the trade book, the Canadian dollar. Still looking at the Canadian dollar. Got caught up in a little bit of a whipsaw action in earlier trading sessions. I was actually using the Canadian dollar as a bit of a canary in the coal mine when it comes to the dollar index reversal. So the correlation between the dollar index and oil remained negative. So dollar goes up, oil goes down. Dollar goes down, oil goes up. Also, Canada exports a decent amount of oil. So whenever you see a change in the price of oil, you see a relative impact in expectations for the Canadian economy. Okay. The market forces that are pushing the dollar down were also pushing oil up. And so, as an offset, being that the derivative side of the portfolio was leaning more towards a long dollar trade, the spot forex was leaning more towards a short dollar trade. So I went short dollar, long Canada. And the trade was beneficial, similar to the long New Zealand. It was a long dollar, short New Zealand, I think. Whatever it was on previous. But as of currently, with the dollar Canadian, so with the reversal in the dollar Canadian, I took a small loss on the spot forex trade, reversed the position as I started seeing confirmation in other parts of the market. So then, after I saw the reversal in the spot forex dollar Canadian, took a loss. I started seeing confirmation in the dollar index. Looked at the correlations, saw that the correlations had switched back with the 10-year in gold. Then looked at the continued sell-off in gold, the weakness in stocks, and that convinced me of a long dollar, short commodity type trade. So reversed the position on the Canadian dollar. The idea is, as the rest of the trade book benefits from the dollar reversal, the spot currency, the spot forex position would benefit as well, and is no longer trading countercyclical to the rest of the trade book. Also, with the 10-year, the 10-year Treasury, my options spreads. Again, all of my option spreads expire typically at the end of the trading week. I try not to carry or hold options over weekends. Simply because the analysis that I do is a medium term analysis, and I think once there is not a steady stream of market data to update the analysis in real time with what's happening in like society with people, and that disconnect invalidates the analysis to a certain point. So all of my options positions are going to expire on Friday, but the options side of the portfolio is leaning more towards a long dollar trade. So the reversal in the dollar now comes at an opportune time, because as my option spreads are running out of time value, now we actually get to see the underlying positions, or the underlying instruments move, and most of them are actually, all three of the spreads are relatively close to breaking even. So, and that's with 2 more trading sessions to go, because we're going into a Thursday trading session, and these contracts expire at the end of the Friday trading session. So, if the sentiment change midweek holds into the end of the trading week, then the dollar appreciation should benefit the trade book, and I should be able to get rid of the options positions if corn retraces far enough, at least the March contract anyway. Then I might be able to offload that as well. And with the dollar euro futures, the break even on the long side of it, which is the front month, was so close to a support resistance level that the price reversal occurred too quickly to capture enough of a return for the risk that was assumed. So the alternative is to let the price reverse with the hedged spread on, and as the March contract appreciates in value, sell that, and in the short time left on the December contract, try to catch some kind of appreciation, get some salvage value out of the position before it expires. Good thing is with the futures positions, I think this one has, let's check. $26 days left to expiration, so probably take me well into December. So that's that. So yeah, that's the trading book going into the final stretch of the trading week. Still holding on to a full book, except for the that one leg of the calendar spread on corn futures. So We'll see how that plays out going forward. Yeah, that's it. So if you have any questions, feel free to email me at contact@runthenumbers.biz. That's contact@runthenumbizs.biz. And I will try to either answer your emailed question during the next episode, or at least respond to your email by the next episode with an answer or a suggestion of a resource that can help you answer your question. But until then, when in doubt, take profits. Happy trading. See you next time.